All right, so we're diving into the world of investment today. I think we all know how important it is to make our money work for us, especially in the business world. And we've got this Wikipedia entry on investment as our source material. It's actually a lot more in depth than you might think.
Yeah, it goes way beyond just a simple definition. We're going to really break down the different types of investments that are out there, especially those that are relevant in the business world. And then, of course, we'll look at the whole risk and reward thing, which is always a big factor. And we'll even get into some specific strategies that businesses use to make smart investment decisions.
Okay, so before we get into all that, let's just start with the basics. What exactly do we mean by investment, especially in the business sense?
Well, the classic definition from our source here says it's about committing resources to get some kind of benefit later on. But I think in the business world, it's really all about putting your money to work.
I like that, putting your money to work.
Yeah, it's not just about saving money. It's about actively using your money to potentially generate even more money down the line.
Right. It's like making your money an active part of your business strategy, not just something that sits on the sidelines.
Exactly. And just like any good business strategy, you need the right tools, right? So that's where understanding the different types of investments comes in. We're talking about things like stocks, bonds, cash, and real estate.
Okay, those all sound familiar, but why are those considered the traditional types of investments, especially for businesses?
Well, for one thing, they've been around for a long time. They're kind of like the foundation of the financial world. Stocks, for instance, they actually give you a piece of ownership in a company, like a little tiny slice of a big corporation. And then bonds, they're more like loans that you make to governments or companies, and you get a set return on that loan.
Okay, so with stocks, you're betting on the company's success, and with bonds, you're more like a lender.
Right. And then there's cash, which might seem kind of basic, but managing your cash flow effectively is so crucial for any business, especially if you're dealing with different currencies and exchange rates. And of course, there's real estate, which is a tangible asset that you can, either rent out for income or potentially sell later on for a profit.
Right, so these traditional investments, they each have their own role to play in a business's overall financial picture.
Definitely.
I've always been fascinated by the history of the stock market. I bet there's a pretty interesting story behind how those first stock markets came to be.
Oh, absolutely. Those early stock markets, they were like the seeds of our modern financial system.
It's amazing to think about how they've evolved over time. I mean, can you imagine those bustling trading floors, all those people buying and selling shares, and how those transactions were shaping entire industries? That's wild. Speaking of shaping industries, our source mentioned this really important point about risk and reward, and I think it's something every business owner needs to understand. It basically says that the higher the risk you're willing to take, the higher the potential return, but also the higher the potential for loss, of course.
Right. It's a trade-off. In the business world, just like in life, you often have to take risks to get ahead. But it's important to be smart about it. You need to understand the specific risks involved with each type of investment and decide if those risks are worth taking, given your business goals.
So it's not just about blindly chasing the biggest possible return. It's about being strategic and making calculated decisions.
Exactly. Our source uses this example of biotechnology investments, which are known for being very high risk, but also potentially very high reward. I mean, think about it. If a company develops a new drug that's a breakthrough, the returns could be enormous. But developing those drugs is incredibly complex and expensive, so there's also a high chance that the investment could fail.
All right, so you could hit the jackpot or you could lose everything. That's a high-stakes game.
It is, and that's where diversification comes in, which is this idea of spreading your investments across different asset classes. So you're not putting all your eggs in one basket. If one investment doesn't do well, hopefully the others will make up for it.
Okay, that makes sense. It's like creating a safety net for your investments. So instead of betting everything on one big winner, you're spreading your risk and creating a more balanced portfolio.
Exactly.
So let's get into some specific investment strategies now. Our source mentions value investing, and I immediately think of Warren Buffett. Isn't he like the king of value
And
investing?
he's definitely a master of it. Yeah, value investing is all about finding those hidden gems, those companies that are undervalued by the market. They might have strong fundamentals, but for whatever reason, their stock price is lower than it should be.
So it's like finding a diamond in the rough.
Yeah, exactly. Value investors are really good at doing their research and analyzing a company's financials to see if the stock price is truly reflecting its real value.
They're looking for those opportunities where the market might be overlooking something.
Right. They're looking beyond the hype and trying to assess a company's intrinsic value, which can be tricky. It takes a lot of patience and discipline.
It sounds like a skill set that would be valuable in any business, not just investing.
Absolutely.
Okay, so what about growth investing? That seems like it would appeal to those who are looking for more aggressive returns.
Yeah, growth investing is all about targeting companies that have high growth potential, those companies that are really disrupting their industries and are expected to expand significantly in the future. They're the innovators, the game changers.
So you're not necessarily looking for undervalued companies. You're looking for companies that are on the rise.
Exactly. You're hoping to ride that wave of growth and profit from the increase in the company's stock price as it expands.
So capital appreciation is the name of the game with growth investing.
Yes. And it can be a very rewarding strategy if you pick the right companies. But of course, it's also riskier because there's no guarantee that those companies will actually live up to their potential.
Our source mentions this guy, Thomas Rowe Price Jr., who was a pioneer in the world of growth stock investing.
Oh, yeah. Price was a visionary. He really understood the power of investing in companies that were operating in high-growth industries. He believed in finding those companies that were well-managed and had a solid track record of innovation.
It's amazing how these investment philosophies have evolved over time. Now, what about momentum investing? That one seems like it's all about timing the market perfectly.
Yeah, momentum investors are constantly on the lookout for stocks that are currently trending upwards. They try to jump on that momentum and ride the wave as long as they can before it crashes.
So it's a bit more fast-paced and maybe a little bit riskier.
It can be. It requires a lot of attention to market trends and the ability to make quick decisions. Momentum investors often use technical indicators like trend lines and moving averages to help them identify those short-term patterns in price movements.
Sounds like you need to have your finger on the pulse of the market at all times with momentum investing.
Yeah, you definitely need to be comfortable with a higher level of risk and volatility if you're going to be a momentum investor.
Now, our source also talks about dollar cost averaging, which seems like a more measured approach.
Yeah, dollar cost averaging is all about taking the emotion out of investing and creating a disciplined, consistent approach. The basic idea is that you invest a set amount of money at regular intervals, like every month or every quarter, regardless of what the market is doing.
So instead of trying to time the market perfectly, you're basically averaging out your purchase price over time.
Exactly. You're taking advantage of market fluctuations by buying more shares when the price is low and fewer shares when the price is high.
Our source gives this great example. If you invest $500 a month, every single month, for 40 years, and you get an average return of 10% per year, you'll end up with, wait for it, over $2.5 million.
Yeah, that's the power of compounding. It's like a snowball effect. The longer you invest, the more those returns start to build on themselves.
That's amazing. So dollar cost averaging can really pay off in the long run, even if you're starting with relatively small amounts of money.
It's a great strategy for anyone who wants to build wealth steadily over time without having to worry about timing the market perfectly.
This has been a fantastic deep dive so far. We've covered a lot of ground already, from the basics of different investment types to some of the more popular strategies that businesses use.
It's a lot to take in, for sure. But I think it's important for anyone involved in business to have at least a basic understanding of these concepts.
Absolutely. Okay, so we've talked about these like traditional investments and some of the big picture strategies. But what about people who are just starting out, Like, let's say you're an entrepreneur, you've got a great business idea, but you don't have a ton of cash to invest. Is there a way to get into the investment game without, like, breaking the bank?
Oh, absolutely. Our source mentions this thing called micro-investing, and it's perfect for people who are just starting to build their business and their investment portfolio.
Micro-investing, huh? So is that like investing with tiny amounts of money?
Pretty much, yeah. Instead of needing, thousands of dollars to get started, you can invest small amounts, like maybe just a few dollars a week, or even round up your purchases to the nearest dollar and invest that spare change.
Oh, interesting. So it's kind of like the idea that small, consistent actions over time can lead to big results.
Exactly. And over time, those small contributions can really add up, especially with the power of compounding. It's a great way to dip your toes into the investment world without feeling overwhelmed.
Right. It's like building a habit of investing, even if you're starting small. Okay, so our source also talks about these things called intermediaries in the investment world. I think they're like institutions like pension funds and banks and insurance companies that kind of act as a middleman between individual investors and the markets.
Right. These intermediaries, they basically pool money from a bunch of different investors and create these big investment funds like mutual funds or ETFs.
Okay, so instead of investing on your own, you're kind of joining forces with other investors through these intermediaries.
Exactly. And that allows individual investors to diversify their investments, spread their risk across different assets without having to manage a complex portfolio all by themselves.
So it's like having a team of experts handling your investments for you.
That's a good way to put it. Yeah, they have teams of analysts who research and select investments for their funds, so it takes some of the guesswork out of it for the individual investor.
That sounds pretty appealing, especially for busy business owners who might not have the time or the expertise to be constantly researching and monitoring their investments.
Yeah, definitely. It can be a lot less time consuming and less stressful than trying to do it all yourself.
But, I mean, there's no such thing as a free lunch, right?
Yeah.
Are there, like, fees involved when you work with these intermediaries?
Yeah, you're right. There are fees. So it's important to understand the fee structure and how it might affect your returns. Transparency is key.
Right. Transparency is always important. Okay, now our source throws out this term, investment valuation, and it kind of makes my head spin a little bit. It sounds really complicated. Can you break it down for us?
Yeah, investment valuation might sound intimidating, but it's really just about figuring out how much an investment is actually worth. Like, how much is that stock or that business really worth?
Okay. So is it kind of like getting an appraisal before you buy a house? You want to make sure you're not overpaying.
Right. Exactly. Investment valuation helps you make informed decisions about where to put your money and can help you avoid some costly mistakes.
Okay, that makes sense. Now, our source mentions this thing called free cash flow, which honestly sounds amazing. But what exactly is it, and why do investors care about it so much?
Free cash flow is basically the cash that a company has left over after paying for all its operating expenses and capital expenditures.
So it's the money that's available to either reinvest back into the business or distribute to investors as dividends.
Exactly. And companies with strong and consistent free cash flow are generally seen as more attractive to investors because they have more flexibility. They're not as dependent on external financing.
Right. It's like having a healthy savings account. It gives you more options.
Absolutely. Now, another term that's thrown around a lot in the investment world is the debt to equity ratio. This one can be a little tricky.
Yeah, I remember that one from business school. It was definitely a little confusing. Can you give us a refresher?
Sure. The debt to equity ratio basically measures how much debt a company is using to finance its operations compared to the amount of equity, which is like the ownership stake of the shareholders.
So a high debt to equity ratio means the company has a lot of debt, right? And does that make it a riskier investment?
Oh, it can, yeah. While some debt can be healthy for a business, like if they're using it strategically to grow, a high debt to equity ratio can be a red flag. It might mean that the company has high interest payments to make, which can eat into profits. And it also means they might be more vulnerable to economic downturns.
It's like walking a tightrope, right? Some debt can help you move forward, but too much can make you lose your balance.
Yeah, that's a good way to think about it. Investors often look at the debt to equity ratio as one way to assess a company's financial stability and risk profile.
Okay, so we've covered a lot here. Micro investing, intermediaries, valuation, free cash flow, debt to equity ratio. It seems like there's a whole universe of investment knowledge out there. It can be kind of overwhelming, honestly.
Yeah.
What advice would you give to business owners who are just starting to explore the world of investing?
I would say start with the basics. Get a good understanding of the different types of investments, the whole risk and reward thing, and some of the key strategies we've talked about. Don't be afraid to ask questions, talk to financial professionals, and most importantly, just start somewhere, even if it's small.
Yeah, don't let the fear of the unknown hold you back.
Exactly. Investing is a journey, not a destination. And the more you learn, the more confident you'll become.
Well said. This has been really insightful. We've explored the fundamentals of investing, looked at some popular strategies, and even gotten into some of the tools and metrics that investors use to make smart decisions. Welcome back to our deep dive on investment. It's been a pretty intense journey so far, right? From the basics to some pretty advanced stuff.
Yeah, we've covered a lot of ground, but I think the main takeaway is that understanding how investing works can really make a difference in the business world.
For sure. One thing that's been on my mind is you mentioned earlier that there's no one-size-fits-all approach to investment. It's not like
Hmm.
there's one magic formula that works for everyone, right?
Exactly. What works for one business might be a total flop for another. You really have to create an investment strategy that aligns with your specific goals, your risk tolerance, and of course, your overall financial situation.
Right, it's got to be tailored to your business. So it's not about just like chasing the latest trend or trying to copy what someone else is doing. It's about creating a plan that's right for you.
Absolutely. I mean, think about it. A young startup that's, really focused on growth might be more comfortable taking bigger risks. They might go for those high growth, high reward investments, even if there's more potential for loss. But a more established company that's, maybe more focused on stability and consistent income, they might prefer something more conservative, like dividend paying stocks or bonds.
Right. It's all about choosing the right tools for the job. You
Yeah.
wouldn't use a hammer to fix a leaky faucet. Yeah.
Exactly. And no matter what your goals are, diversification is key. Don't put all your eggs in one basket, as they say. Spread your investments across different asset classes so you're better prepared for whatever the market throws at you.
Yeah, build a solid foundation. So it's like, the more you understand about investing, the better equipped you are to make smart decisions for your business.
Definitely. Knowledge is power, especially in the world of finance.
Absolutely. Don't be afraid to do your research, talk to financial advisors, really get a handle on how things work. It's a learning process for sure.
Yeah, investing is a journey, and the more you learn along the way, the more successful you're likely to be.
Well said. So before we wrap up this deep dive, we always like to leave our listeners with a little something to think about. Considering everything we've discussed and the state of the economy right now, which investment strategy do you think holds the most potential for